So for today's deep dive, we're trying to look at the invisible machinery of the markets. Because when you strip it all down, the entire securities industry is really just one massive bridge.
It absolutely is. It's a bridge that connects the two groups that, make the whole economy run.
Right. On one side, you've got the issuers. So corporations,
Yeah.
governments, people who need money.
They need capital to build things, to grow, to pay their bills. And on the other side, you have the investors, people with capital who want to put it to work.
But they can't just, they can't Venmo each other a few $1,000,000. They need some kind of infrastructure.
Mhm. And that's where the financial firms come in, the broker-dealers.
And this is what I found so interesting in the source material we looked at. These firms, the broker-dealers, they have this serious split personality. It's not just a job title. It actually determines whose side they're on.
That is the most critical distinction.
Yeah.
A firm can act as a broker, or it can act as a dealer.
Yeah.
And how they act totally changes their incentives.
Okay, so let's take the broker side first. The texts call this acting in an agency capacity. The way I started to think about it was like a real estate agent.
That's a perfect analogy.
They connect me, the seller, to a buyer. The agent never actually owns my house, where they just make the introduction.
And for that introduction, they get paid a commission. There's a handy little memory aid for this one. ABC,
OBC.
agency, broker, commission. They're just a matchmaker. It's basically risk-free for them.
Okay, but then that same firm can flip a switch and suddenly act as a dealer.
Right. And now they're a principal. They're not matching anyone. Now they're trading directly from their own inventory.
So to go back to the analogy, they're not the real estate agent anymore. They're more like a used car dealership.
Exactly. They bought the car, it's on their lot, and they're selling it to you for a profit.
Mm-hmm.
They have their own money on the line.
They have skin in the game.
And because they're taking that risk, the risk that the car's value might drop, they don't charge a commission. Instead, they charge a markup when they sell to you.
Or a markdown if they're buying it from you. So if I see commission on my trade confirmation, they were a broker.
And if you see a markup or markdown, they were a dealer. They were the other side of your trade.
Which brings us to where this all happens. The venues. We hear about the primary market. That's basically the new market, an IPO.
That's where the issuer, the company, actually gets the money.
But most of what we think of as the market is the secondary market, the used market.
Mm-hmm. When you buy a share of some tech company, you're not buying it from the company. You're buying it from another investor who decided to sell.
And we assume that happens on, the NASDAQ or the New York Stock Exchange.
For a lot of listed stocks, yes.
Yep.
But the public exchanges are really just the tip of the iceberg. There's a huge amount of trading volume that happens completely out of sight.
In a dark pool?
I love that name. It sounds so, nefarious. But it's not really about that, is it? It's more about fear. It's about fear of something called slippage. Imagine a giant pension fund needs to sell, say, 1 million shares of a stock. If they just post that huge for sale sign on the public NASDAQ exchange.
Oh, the market would see it and panic. The price would tank before they could even get the order filled.
Precisely. So they go to a dark pool to hide their intentions. The quotes are concealed. It lets them move these massive blocks of stock without tipping their hand and crashing the price.
So it's a stealth operation. But whether the trade happens on the NYSE or in a dark pool, it all has to go through the plumbing.
The clearing and settlement process. And in the U.S., that's almost entirely dominated by one entity, the DTCC.
The Depository Trust and Clearing Corporation.
Think of them as the giant central accountant for the whole market. We don't mail physical stock certificates anymore.
No, thank goodness.
It's all electronic. It's called book entry. The DTCC just automates that swap of cash for securities between the firms. It's what keeps the whole thing from collapsing.
But not every brokerage firm connects directly to the DTCC, right? The notes pointed out this kind of hierarchy.
Well, it's incredibly expensive to build and maintain that direct connection. So you have what are called clearing firms, the heavy lifters who do connect to the DTCC. And then you have introducing firms.
The app on your phone?
That's probably an introducing firm. They're client-facing. They have the nice interface, but they outsource all that back-end settlement work to a big clearing firm.
And the clearing firm might not even know who I am.
If it's what they call an omnibus account, no. They just see your broker's name on a giant pile of trades. The only big exception to this whole BTCC system is options.
Right. They have their own clearinghouse, the OCC.
The Options Clearing Corporation. Different asset, different risk, so different plumber.
So to recap, we've got the issuers who need cash, the investors who have it, and the broker-dealers as the bridge in between.
Who can act as either agents or principals.
And it all trades on exchanges or in dark pools, and then gets settled through the invisible plumbing of the DTCC.
That's the ecosystem in a nutshell.
But I keep getting stuck on the dark pools. If all the big institutions, the smart money, are trading in the dark specifically to avoid moving the public price, does the price I see on my screen really reflect the true supply and demand at that moment?
That is the billion-dollar question, isn't it? If all the real price discovery is happening where we can't see it, then what we see in the light might just be a shadow.